Hey, this is Mark Eitel, host of the Mr. Mortgage Show, and you're listening to The Daily Dose, where we dive deeper on one subject each day. Today, I want to talk about homeowners insurance. Now, I had an interesting circumstance today. We have a client who was pre-approved to purchase a property, and whenever anyone is pre-approved, we use an estimated homeowners insurance premium amount. Because without the exact property, there's no way to get a very specific quote. So we always use a rule of thumb. Now, here's something interesting that happened. On this particular property, the insurance quote estimate in the approval was $2,400. So we used a $200 a month calculation for the insurance portion of the mortgage payment. Well, the policy came back at $7,400. Significant difference. So in that instance, the monthly payment, if I'm doing this from memory, was well over $600. I think it was around $640. So nearly $440 more of a monthly payment. So sadly, that premium amount pushed the debt to income ratios into a range where the client no longer qualified. Now, this is why I'm sharing this information. We jumped on the phone and had some additional insurance agents quote the policy, and the range of premium amounts was wild. I mean, we had premiums as low as $1,800 a year, $2,800 a year. We had one at $2,100, and then the original quote at over $7,000. Now, the reason I'm sharing this is you always want to get the best insurance coverage that you can afford. However, the insurance portion of the monthly payment often goes unlooked when you're doing your debt to income calculations to see how much of a mortgage payment you qualify for. So imagine in that example I just used, that additional $400 a month in payment greatly reduced the amount that this borrower was qualified for. So luckily, we were able to scramble and get that insurance requoted, and he went with the middle of the three policies and was able to continue to move forward. The loan's qualified, and he's going to close in about a week. But I share that only to demonstrate the value of receiving a second opinion, or in this case, even a third opinion, when it comes to insurance. Now, we have a roster of agents that we refer clients to regularly. So that's where we had a pretty good idea of that 2,000 original guesstimate, if you will. And the policy that the client ultimately chose was pretty close to that, just a little over $2,100 a year. So in the end, he qualifies. He's going to buy the house. He's well insured. One thing to remember when you have a mortgage, the full replacement value of the property needs to be covered in the insurance because, God forbid, there's a total loss. The lender wants to make sure there's enough insurance to rebuild the property as it is. So you want to look at details like contents coverage and additional liability coverage. But from the lender standpoint, at bare minimum, you're going to have full replacement cost coverage. And then from there, things like the age of the roof, the condition of the electrical. So for example, an older home that may not have an upgraded electrical panel. And lastly, hurricane protection. So shutters or impact windows. Those three things, the roof, the electrical, and the hurricane protection, carry a significant weight in the calculation to determine the premium of the property. But anyway, if you have questions about insurance, I'll be happy to get you in touch with a good agent. You can just call or text our office. All right, that's it. That wraps up another Daily Dose. We'll be with you again tomorrow with another tip or deep dive on a particular topic. And if you found any of this interesting, we encourage you to tune in Saturday mornings at 9 o'clock and listen to The Mr. Mortgage Show live at 9 on iHeart, or check out the podcast replays at themrmortgageshow.com, or check out the Facebook page. Go to Facebook and search The Mr. Mortgage Show. There you'll find a lot of useful information. Again, my name is Mark Eitel, and you've been listening to The Daily Dose.